Hey guys, Frank Curzio here with a live video, and I wanted to talk about Disney. Disney was a company I shorted personally that I told everybody I thought it was going to fall tremendously. It's one of the most expensive stocks, and this was back in April, and now the stock is really ramping higher. So in this segment, I want to talk about what I did wrong. I know it sounds crazy because you're not going to hear another analyst ever say that, but if you want to be the best at what you do, you got to focus on your mistakes. If you look at Michael Jordan when he came to the basketball league, he's one of the worst shooters ever, and by the time he left, he became one of the best mid-range shooters ever, right, in the history of the NBA. So for me, I focus on my losers more than I winners. So I want to break down Disney and see what I got wrong, what's going on with the company now. So I want to share this report from Disney, and this is Disney's from J.P. Morgan. This was from August 5th, so this was yesterday, and they're talking about everybody knows it. Their subscribers, they did very well, 60 million. Mulan's going to come out. They have a 29.99 price tag on Disney Plus, which is interesting. That's a different business model. When I look at the numbers, though, look, I mean, right here, 577 to 150. I mean, earnings declined tremendously. You're looking at a company where they saw revenue decline 40%. They took a write down on their parks business. You're looking at, and we'll go to JP Morgan because they call it their top idea, which is interesting, yet they only have a 135 price target on it, which is where it is now. So when you go down even further, I want to show you guys something. I mean, look at the revenue, right? Okay, 2020 is a wash. We understand it's going to be bad, but still, even revenue is not that high for a company trading at some crazy valuation. But when you dig down to the results, you see the 60 million subscribers here. ESPN Plus, 8.5 million. Average revenue per user declined 22%. Hulu, average revenue per user declined 10%. Direct to consumer, which is their streaming business, revenue is 4 billion. That's great. Operating loss was 706 million. The Bulls are going to highlight, hey, Disney said 1.1 billion they were going to lose, but it's worse than the 500 million that they lost last quarter, which means what? Bringing this all together is that the more subscribers they're adding, the more money they're losing, right? Because it's a money losing business. However, Mulan might make a very big difference, and that's going to be interesting for Netflix, for Disney, and I can tell you if they get this right, Disney can really explode higher from here. But when you look at what I got wrong, because everything I look at this company when I look at fundamentals says it should have gone down and it didn't. And when you look at the Fed and what they're doing, nobody expected 12x the amount that they would spend, 30% of GDP, $6.5 trillion, right? Pretty crazy number. You're looking at Disney itself, where people don't care about valuations, right? And from my lesson learning from Disney is I was bearish up until April and into May a little bit, but when I saw what was happening at Disney and losing money on that personally, and seeing some of these stocks really rebound, the Fed was there to help out the entire market. You're looking at valuations where people are willing to overlook things if there's positive trends. But when you're looking at Disney here, if the stock is not down, it wasn't trading under 100 or something like that. I'm looking at Disney here, but the fact that it's at 130 with average revenue per user declines at every single division, and also they're not really expecting earnings to go up. I want to show you one more chart before I let you go because I like to keep these things quick. And let me show you right here. And if you look at Disney here, so this is their forward earnings, which I'm going to show you. So the metrics. It's really cool. So just go to forward PE. And this is a company right here. Look where it was. It was trading at over 300 times forward earnings. Now it's down here because they're expecting earnings to be a couple pennies, and they beat. So it's still trading at over 80 times earnings. To put that 85 times forward earnings, put that in perspective, look at that 5-year, their 10-year. This is a stock that you're used to trading at 15, 16, 18 times forward earnings. It's trading at 80-something times earnings. Right now, if people are willing to give that premium, if COVID ends, right, if we find a vaccine, Disney's market cap is about $200 billion. This is a stock that could easily go to $400 billion if that ends, because they're impacted the most. But people are willing to overlook that. They want to pay 80 times forward earnings. There's a lot of positive sentiment, so I don't fight that trend. But again, I want to cover my losers because you're not going to hear a lot of analysts do that around there. And again, I want to keep this short, but it's very important. Those are the lessons you learn the most. You're going to get things wrong from time to time. I got Disney wrong, but you learn from those lessons. That's how to become a very great investor. And we've done fantastic in the markets for my subscribers. Not only getting them out when the market crashed, but also getting in a little bit later. But now our portfolio is doing fantastic. And that's how you learn from making mistakes. But hopefully, especially me, I don't make too many more for my subscribers. Hey guys, Frank Curzio, as always, email me frankcurzioresearch.com. And I'll come back to you guys soon. Take care.